welcome to a new episode of the Life Science Get Together podcast. Today with a very special guest from France and meanwhile Austria, Sebastien Groyer. Welcome.
Thank you, Christian, and welcome everybody. Happy to be here and to discuss about life sciences and what I've been doing for the last 20 years and in the next 20 years, I hope.
I'm really curious about your seven tales from the other side of the negotiation table. I started in life science in 2006 and since then mostly supported companies. And what I see, especially in the last 1.5 years, it's incredible how the industry evolved. I just checked the numbers before I went into the recording with you. And in 2011, for example, we had 720 million life science investments, and it scaled up to 3.7 billion euros in 2017 when I started this Life Science Get Together event series. And in this year, we already had, up to June 2021, we already had $6 billion life science investments, which is basically matching the number from the entire year of 2020. And within these years, I experienced always one side of the negotiation table and not the other side. So it's really a good thing to have you on the podcast. And let's dig a little bit into how you see life science investments, what happened in your life, and what successes and failures you created over the years. My profession in companies usually is that I support life science entrepreneurs, which are mostly scientists, in planning their companies, structuring the story to then put it on the negotiation table with venture capitalists. And there is always this dichotomy in planning. So part of the people swear on it and say this is absolutely the best thing. And the other part of it say you can't just ditch it, it's unnecessary. When we start working on something, reality changes everything. So the first question to you is, what is really the view of the venture capitalists on planning when you see shiny and glowing numbers for the coming 20 years?
Yeah, actually, that's a great question because it's something that VCs can laugh about or just be a bit sad about when you see these huge numbers in the next 5-10 years and you know they're never going to realize. And you know it's just to defend some sort of evaluation, a position in the company, and to try and present an attractive investment opportunity to VCs. So there's always this reality check then to say, okay, is it really credible and does it affect the credibility of the entrepreneur in front of you? Because it's two sides of the same coin, actually. You have to be able to sell a dream, and that's what entrepreneurs do, in a way, sell a dream to VCs too, but also sell reality and be able to say, okay, we're not going to give crazy numbers that are going to be affecting the way we look at the market and the way we can create value. So it's a bit of a double way to look at it. You have to be exciting enough, but also realistic enough. So that's really an interesting way of thinking. And I'm sure that all VCs realize that it's just a business plan with Excel sheets and numbers and PowerPoint presentation. And in reality, it won't happen. Everything is going to be so uncertain and so different that it's just, let's say, a vision, a direction of where the company wants to go. And then everything is going to be moved. And I'm not even talking about the COVID crisis or these pandemic things or gigantic seismic crisis. I'm just talking about a new competitor, a new technology, different customers, different way of developing, orders in employing people, recruiting, IP issues. So everything is going to be always different. So one thing I was really looking at when I was a VC, and I've been doing that for 20 years. So do I fit with the entrepreneur in front of me? Can I live with him like for the next 5 to 10 years? Because actually it's some sort of a marriage with the entrepreneur and the VC. You're going to have a strong professional relationship for the next 5-10 years and maybe longer if you really get along. So do I want to work with this guy or with this woman in front of me? Because this is something that is going to be an not an everyday, but every week life of my life. And so I need to have this relationship. So I think you should focus on the material things like the technology, the IP, the business plan, etc. But you also try and see how do you fit in terms of person with the people in front of you, because this is going to be so important. And this is a huge part of the success of companies, recruiting the right person and having the right people and relationship with these people.
Good. It's good to hear that everything is about relationship. But let's go a little bit back to this planning exercise, because also in incubation and acceleration programs, the trainers and the people who set up the programs spend a lot of time in planning exercises and training people into planning. And they always wondered what happens on the VC side. So we put the plan together, and of course everything can change, but usually these changes happen anyways. How do VCs perceive such changes, and how should entrepreneurs approach a VC when they see, okay, guys, we cannot fulfill the plan, so we have to change this and that? What is the right approach in your eyes?
In my eyes, you have to be really transparent about it and try to just explain why you want to change the direction. You set a direction at day one of the, let's say, the investment of the first meeting, and then of course everything's going to change. So you have to be really, let's say, transparent and rational about why you want to change direction, because this is a boat. You're going to go right, left, up, down, depending on where you want to go. But you have to have an explanation about why. And it's not just we did it wrong first. It's just things have changed. We refined the market positioning, we refined the technology, the products, the competition. But you really have to do that. We know we live in an uncertain world. If we were not in an uncertainty business, we would just be an insurance product, and every startup would get €1 million with a nice average rate, and you will give it back, and you will have a reward at the end, and we would not be needed anymore. I think this is a dream of some LPs in venture capitalists, to be able to say, okay, I'm going to get a 10% per year reward, and if I invest in large enough quantities of money in different startups. But it doesn't work that way, because one is going to make a lot of money and many others are not. So you have to choose carefully. So this is a distinction between uncertainty and risk, and we're not a risky activity. We are an uncertain activity. So it's really 0 or 1 at the end. And so to come back to your question, I think you really have to say, okay, I made a plan to know and to tell people how much money I would need to go to which point of value creation or maybe an exit. If it's changed, if everything has changed, and it will change, you have to explain why. It's a better plan, it's another plan, and just be really transparent about it, and not try to hide the fact that maybe some ideas were wrong or some hypotheses. You just show the numbers and you try to have a discussion. And of course, it can get heated in the moment, because people are going to react and say, "What? Sure. It's not the real plan. It's not what we wanted to see." But then the reality strikes, and you have to say, okay, and admit it. And so a bit of humility is good, and say, okay, I was wrong in this part. This part I was right, and we need to go into more this direction than this one, and try to elaborate. And it's always good to have feedback from customers, partners, competitors, etc., to try and show that you're not deciding that just on your own will. It's just a basic market research or interviews or customer feedback, saying, okay, we need to go this way and this way. And I think the best entrepreneurs are the ones who listen the most, listen to the other people, to other point of view, so that they can adapt and move in real time. And it says, well, this thing about pivoting in the industry, like when do you pivot or pivot back, etc. You don't have to pivot every day, but you have to be flexible enough to try and change over the course of time and say, okay, I'm adapting my course and my directions. So that's for me something really important, to be able to share with the VCs the world why the company today is different from the company yesterday, and it's going to change all time during the whole process of the startup and every company. So yeah, I think you really have to listen and to be able to expose why you're changing, and be open to feedbacks. Maybe the VC in front of you, or maybe the customers in front of you, have a very great knowledge of what you haven't seen, and they can give you some really nice feedback to try and evolve the company. And then in the end, it's your decision as an entrepreneur. So you own it, you go for it, and you try not to have regrets.
No, I think being wrong is it's a natural part of the process when we develop a company. Nobody can 100 100% predict the future, if that would be possible, I would definitely put some money onto this company.
Yeah, but I would say that you need a plan for VCs because you need to show them how much money you want to raise and what's going to be the next point or the next target. So if you don't do a plan, you could say, yeah, every plan is wrong, so why spend more time on these things? But it's a way to refine the way you think, to try and see where you want to go, and to, at the end, put numbers on the table and say, okay, I want to raise $110, $100 million. The idea is, why would you raise that much money, or for what would be the reason? You need a plan to be planning. And so you're going to spend a lot of time on your Excel sheets with your CFO, your partner, etc., to try and put some numbers on the table and say, okay, it's not just I want 2 years of salaries and then we should discuss again. What do I do? How many people do I recruit? How many investment do I? How much investment do I have to make? Etc. Etc. So yeah, that's much more complicated than just putting a number on the table and say, okay.
That's good to hear. When I think about venture capital investments, I think VC investments is mostly about investing in novel industries. Did I get the right picture of that?
For some of them, yeah. For the most innovative VCs, yes, it is trying to find a nice new trend and see it before the industry and the market and the media even catch it and try to promote it. It's always good to be before in front of the trend so that you can really go with it and benefit from the development of a new market. You can have people saying, okay, I want to go for the business model is set up where you know the customers, you know how you can target them, you know a lot of metrics that you don't know when it's a new market. But then this is not the same game in terms of developing a technology and how big it can be. I really think, and I've done most of my successes in this part, that you have to be ahead of trends and you have to take bets. Of course, some of them are going to fail. This is the everyday life of VCs, but some of them, when they succeed big. So that's why I think this is a big idea to try and see what kind of trends are coming out. And for most people, you can see the trends like 5 or 10 years before, because you're connected with academics, with young startups. You don't necessarily have to invest in the first startup in one field. You can say, okay, this is the first one. I like the field. I'm going to dig in and try to find the one which fits better my needs. But you have to try and see which type of market you want to go. With Seventure, we went directly into the microbiome, which was almost the first European fund, and we made the first investment in this microbiome area. And it was a really interesting trend because in 2008, 2010, it was something that nobody even talked about. They didn't even know the word. It was like, what's microbiome? What are you talking about? And now, 10 years later, everybody knows that. You had huge successful books, you had a lot of media communication, even a few products now, listed companies, etc., etc. So it's starting to be something very interesting. And so, yeah, I think the idea is to be in front of the trend before them. If you get behind, you might be into this, let's say, following technologies of startups, and it might be a bit more difficult to differentiate yourself. So yeah, so that's something that I really enjoy in VC world, is to be able to see a bit of the future with this trend and say, okay, I'm going to bet on robotics, the microbiome, radiopharmaceutical, etc., ahead of the time. And if it works, it's going to be very interesting. If it does not, if we have to wait for the market to be there, it can be a bit of a pain. But long term, I think this is the right approach, and it's going to be very interesting for you as a way to put yourself in the VC industry, because we also have competitors in the VC world. So you have to find a way to say, okay, I'm the right VC for this company, and this is the reason why. And taking early bets might be the best way to attract interesting entrepreneurs and companies, because this is where the money is most needed. When you have to be the fifth investor in a 50 million euro round, yeah, that's good. It might be a profitable exit, but it might not be the most profitable, and you might not be the most differentiated VC in the industry in your country or in Europe, especially. And the US, it's even worse. So I think, you should really think about where you position your company as a VC and as an entrepreneur, because this is, as I said, a marriage. So you have to find the right partner.
That's a good point, pivoting back to the entrepreneur. So from what I understood while you were talking, is that VCs usually invest in trends, in new trends. So when I try to put it in a compelling story for a VC, so I have two ideas. So one idea is as an entrepreneur to look for a scientist who has a novel idea and work on a story to explain why this will become a trend. And the second part that I experienced is to sit together with an entrepreneur and looking at trends that already exist and come up with a list of, let's say, 200 competitors and say, okay, 200 companies already are doing that. There must be something in that. Which story would be more compelling to a VC in your eyes? Would it be the story with explaining a novel trend and being the first mover? Or is the VC world more looking for already established trends in the market?
I think it depends on the type of VC. So most deep tech VCs would go for the first category when you have a new tech and a new trend, and you can really go for it and say, okay, I'm going to disrupt this new market. Let's talk gene editing, DNA writing, these new technologies that are coming up in biotech. They're really disruptive. And when you see the first company, then you see they want to really change the game in these areas. It's really interesting. If you were to be a part of lots of competition, you have to really show that you execute better, that you have a nice advantage, even if it's not a disruption. And so it's easier to get funding when you have a bit of traction from the commercial side in this case than when you want to really finance the technology. And so in deep tech, the hardest part is at the start, is how do you get your first million so that you really develop the tech to make a product, a viable product. And sometimes it's not millions, it's tens of millions or hundreds of millions in case of pharma. So you have to be convincing enough to say, okay, I'm going to create something which is big enough so that you can invest this type of money in my company. And so I think the first mover is quite a huge advantage in pharma, especially with this IP and generics things in the market. In other deep tech companies or industries, you can say, okay, I'm going to be number 10, number 20, number 30 in my industry just because the market is big enough and it's rising enough so that I can really get a share of it. And then it's also an idea about what's my end goal. Is my end goal to become a unicorn or just to become a nice, attractive exit for a larger company that I already spotted? Because when you start your company, one thing you should really do is spot the possible exit at the end so that you can really talk to a VC this way and say, okay, my goal is to be acquired by this type of players or become a unicorn or do an IPO. But you have to show your vision and your understanding of the market and the way VC works. VC's the work. Actually, you can perfectly be a very successful entrepreneur and say, okay, I'm going to create a company and I'm going to sell it between 50 million and 100 million euros in 5 years' time with a nice market niche, with a nice positioning, a nice small tech, and it's going to be perfectly acceptable. And VCs are going to invest in that because they believe in you and what you want to do. And it's completely different when you say, okay, I want to become a $10 billion company and I want to spend my 10 or 20 next years doing that. And I don't want to sell the company early because it's not what I want to create. And so I'm going to try and provide an exit through IPO, through secondary shares, secondary offerings. But really, depending on what is your plan, you also can adapt your vision and your technology on competition and trends. And of course, it doesn't always realize the way you were thinking about. So you just be able to say, okay, I wanted to do a unicorn. It's going to be a 50 million euro company. That's already a great success. So it should not be.
Let's stay a little bit on planning. I know both worlds. So the public company world with coming up with a 300-page plan for the next 20 years, fleshing out every single detail of what will happen in the industry and how the company will react, up to the position of new trendsetters who say, usually when I pitch to an investor, I only need a napkin to flesh out the idea. So when I want to approach a VC, what is the right depth of detail that a VC expects when I pitch a new trend?
I agree with this idea of a napkin because you have to be able to pitch your new idea and your company in one sentence or few sentences. Like you're having a drink at a cocktail bar, you're going to meet someone for 1 minute, and it has to be precise and understandable by everyone, so that even if it's a joke of the technology or the market of the complexity of it, in one sentence, someone has to be able to say, "Okay, I understand what he does and what he wants to do." But at least, and this is a really great exercise for tech companies, especially deep tech, when you have a lot of complexity in what you're doing. But in the end, when you're able to do that with a napkin, it's really great. And I would say you have to go deeper and deeper depending on the interest of the VC. You can really start with a 10-slide executive summary and say, okay, this is what I want to do, how I want to do it in very few words. Are you interested or no? And usually, if people are interested, they're going to say, okay, give me some more details, or let's do a conf call, let's do a Zoom meeting, or anything like that. And you can go deeper and deeper. So I would go by layers, like some sort of an onion. You just start with a very thin layer, and then you go deeper. You don't have to produce a 300 pages business plan because nobody's going to read it in the VC world. So don't bother with that. Just 20, 40 slides or 20, 40 pages of Word document is already a lot. It's already enough. And you have to cover different grounds, of course, like your IP, the competition, the market, the tech, the business model, the recruiting process, the people, the venture numbers, like how much money do you want, what would be the type of valuation, cap table, all these things. But you can cover them in the second round when people understood what you wanted to do and start asking very deep questions. The first part is really to catch their attention and say, okay, this is something new, this is something interesting, and I understood it, and I'm not just looking at, okay, I've read 10, 20 slides, and I still don't understand what is the purpose of this company. And it happens a lot in technology because people tend to go where they are comfortable, and when you're coming from the academia, and when you're coming from science, you come back to science, and you want to show why your science is better than the other. And usually VCs don't really care about that because they know you're going to find a way to put it in a better position than the others. The question is more, what do you do with that, and what kind of pain point or problem do you solve? So it's always a good start to say, okay, this is my problem, this is my solution. And if people understood at least that, it's already a great thing. And VCs are the same. VCs are going to spend a few minutes on your slide deck, and mostly young people, analysts, or even interns sometimes. So they have to be able to understand in a few sentences what you do. And actually, it's a great tool, as I said, because for customers, for partners, if they can repeat the same thing to other people, it's a great way for you for your marketing and communication. So one sentence is usually a good one. And even if people have to ask a lot of questions, then the more questions they ask, the more interested they are. So it's good to have questions back. If you have no question, you're always trying to understand, did I say everything and nobody has question, or did they not understand everything? And so they don't want to ask question because they're afraid. Just welcome the question and let people talk.
So basically it needs both, when I understand you right. So on one hand, the entrepreneur must understand every single detail of the direction he wants to go. So it's the homework, but just taking then this pile of paper, throwing it on the VC table and say, look, I did so much work, it's enough for investment, is not enough. So for approaching a discussion with VC, it means to really drill down from the top, flesh out the core messages that you can write on this famous napkin. So in one sentence, this is what my business is all about. And then in every subsequent meeting, putting more and more and more detail on the table, guided by the questions of the VCs. Is this picture one that you would approve?
Yes, I completely approve that. It's a pyramid. You have to start with the tip of the pyramid and then go down. And VCs are going to ask more and more questions. They're going to go into details. Who do you plan to hire? What is your IP position? What is your competition? Oh, I've seen this market trend. I've seen that and that and that. So you have to be able to answer these questions. And so you have to do your work first and keep it in your bag and be able to get it out with the questions. And this is a tiring work, I would say, because you cannot just say, okay, I have every question and every answer on one piece of book, a PowerPoint, everything. Just read it and come back to me. That's not going to work like that. They want to approve. They want to have their own questions. They have a process of learning. It's also a learning process as a VC. You're in front of someone who's going to teach you something about their technology, their competition, their vision of the world. And so you just have to learn, and nobody learns the same way. So you just have to teach differently to different people, different speeds, different concepts, different ideas. You have some VCs who are going to be very interested in science. Some are going to be interested in market approach. Some are going to be interested in competition, and some in exit. And so you'll have different type of answers and questions. Are you attractive because of the tech? Are you attractive because of your market approach, because of your numbers, your size, your IP? And you'll have this kind of discussion, which will show you the VC interested. Actually, I'm fundraising for a cybersecurity company right now, and I see it because it's a very early stage company with a product which is still in the early progress. It's a prototype. I'm really much more interested in finding tech people or tech VCs than people asking me questions about the market traction and the development of the product and internationalization, because this is so early that I cannot really answer the question with the right answers. And so I'm seeing that it fits much better with tech VCs who love the technology and say, okay, we can make a great product and a great company out of it. And in this case, you have to try and fail. You talk to a lot of VCs and you see the ones that are responsive to this kind of approach, or the ones who just are going to say, okay, come back when you do €1 million revenue. And this is a very frequent answer. Yeah, it's a really nice company. Come back in 2 years, 3 years, 4 years time when you start, and it's already not done, but it's already growing fast. And that's another type of VC. So you really have to look into the different types of VCs and find the right for you.
So adapt to the situation. I think putting it coming from the other direction, just throwing a sentence on a napkin probably is not sufficient, and say, okay, give me $600 million and I tell you in 6 months, so I can put it together. Let's look a little bit about the expectation management when companies start approaching VCs. How many deals per year were you looking at before you made the decision? Is it just that you are sitting bored on in your office, wait for the one entrepreneur once a year that comes along, and then you're happy to invest because just the only opportunity on the market? Or do you get hundreds and thousands of pitch decks on your table?
Yeah, so I think we should start with the dirty secret of VCs, which is to invest when we have money. And so some of the time you will have VC in front of you and they don't have the money in their hands. They pretend, they say they will have it, but they don't have it because they're fundraising their own fund, because the last fund is ending, because of whatever reason, market situation. They're waiting for a few exits to show that it's a good activity and people should invest in their funds. And sometimes you're just going to be in front of VCs that they don't have the money. So the first thing is to be able to check and be sure that they have enough capital available and they can invest. Otherwise, you can just be pitching to them, and whatever the success of your company and the beauty of your concept, you're not going to get money because they don't have it. So this is a bit of the dirty secret of the VCs. They first need to get their own money so that they can invest it inside to you. So that's the first part. Second part is, you really want to see the most possible opportunities because you don't want to miss out the ones that you're going to like. And VCs are like, let's say, top models, which you really pick one out of hundreds of companies. So they just really want to be sure they haven't missed out some possibilities. So we're going to go out and look for deal flows. Conferences, trade shows, networking, academia, of course, direct contacts from people. You can always send your pitch deck to a VC that you found out on LinkedIn or through your network or in conferences. It's always a welcome way of reaching out. So the only problem is that, how do you become this 1 out of 100? That's a very, really tough question. And as I said, try to identify what this kind of VC is looking for. Is it looking for tech? Is it looking for growing companies? Is it looking for new trends, or just, let's say, best in class instead of first in class? that's something you really should try and see, so that you see if you fit with this kind of idea. And the more I was doing my VC experience, the more I was thinking, okay, actually, you should not be reaching out to hundreds of VCs. You're going to waste your time. So maybe you should just try and focus on the few tens of VCs that are going to be in your window of opportunity and your target group as your customers. Actually, they are your first customers. The VCs, when you go and pitch them and you don't have a product and you just have a tech, your customer is your VC. So you just go and pitch something, and you have to focus on your target group and what you're going to sell to them. So try to find the right partners. And then how to become the 1 in 100, I would say you really have to stand out. So highlight the trends, highlight the tech, highlight the the development stage, highlight what makes you different from the others. And it's always good to look around. It's always good to try and see, okay, who are my competitors in this field? What are the other trends? Why are these people choosing to invest in this kind of activity and I'm in other kind of industry? What is the reason for that, and how can I address their concern about it? If I'm a deep tech investor, then I've been investing in, let's say, renewable energy, I might not do some new biotech thing. So why is that? Is that because they are not comfortable with the industry? Or is that because you have to have some sort of understanding of the technology and they are not good enough? And so it's a way of trying to fit in the right boxes and then reach the right partner in the team. Also, if you go and talk to the wrong partner in the VC team, you might just get the wrong answer because you were not talking to the right person. So it's always good to see to say, okay, I'm going to contact this type of person. What are the deals that he made recently or in the past? What are the industries is the most experienced with or accustomed to? Because sometimes it's really easy. You've done a good deal in, let's say, heart disease. You have some expertise there. You want to keep going in this type of area. You've done a good deal in cancer. You want to keep going in cancer. That's just for biotech. It's the same for the deep tech industries. So just try and look at the right one. And in the end, to be this 1% of success, you really have to show that you're going to let's say, outperform the others. You have 10 other projects very sexy on the table of the VC. Which one is going to be selected? The one which is going to be the most attractive to the partner and the VC. So you have to be credible and dream enough and dream high enough. So that I'm going back to this thing, like, it's in the end you have to make the people dream and say, okay, I want to invest in this company because I want to dream with them and I share their dream. And so that's a tough exercise. It's a tough exercise because you don't really have anything else to show at first. And then when it's later stage, it's a bit different. It's much easier to raise money when you're doing like 5-10 million euros of revenue, you're 20, 30, 50 people. It's another game. The first part is the hardest, but that's not why you should be discouraged. You should start. It's really fun.
So there was an interesting point in your explanation that I would like to dig a little bit deeper into. I get many, I support scientists, and very often I get this opportunity on the table, which tells a story like, look, Christian, we're running out of money in 2 months. Let's start approaching VCs. So we need money in 2 months. This then leads to a situation that basically the scientists don't know the VC world, and they didn't have any first contact with VCs, and start throwing out the pitch deck to hundreds of VCs, and which means they must start with the process of finding out what VCs want when they are in desperate need of money. And when I asked them why are you doing that, the answer is, well, someone told us when we talk too often with the same VC, we get blacklisted. So we don't start talking with them. And my opinion is the right approach for an entrepreneur would be to start talking with VCs, learning to understand them, what they are looking for, what the sweet spot is on the market, in which tech they invest before they actually need money or before they actually start a company. So that when they come into a situation, they say, okay, I have a great idea, I have a great company, and now is the right time to invest in that company because it's going to be big, that they already did this marketing phase. So my question to you is, does a blacklist really exist in the VC world where they just check off, okay, this person contacted me 20 times without any deal, so I don't talk to this person anymore?
It's not really a blacklist, but it's of course not a great sign when you go, and you keep going back to the VC every 6 months or a year because you haven't really raised money, you haven't done what you were saying you would do. So that's a bit of a bad negative signal for the VC. So yeah, I agree. You should not come back every 3 months, 6 months, 9 months to the VC and say, "Hey, now I'm raising money again, and I want your, I want your money." That's not a good sign at all, of course. But I agree with you on this side, on this point. Like, you should not start fundraising when you think you need the money. Actually, you should be fundraising all day. That's something that's always an ongoing process because it's the future of your company. How am I going to raise money in the next 12 months, 18 months, 24 months? So it's always good to have this in mind and say, okay, what I'm going to do and sell and say in the next months or quarters, so that I can raise the money and show what I've done. I think that the best way to start would be to reach out to a VC and say, look, I'm going to raise money in 6 months from now, but since I know you're in my area, I know you're in my expertise, I know you might be the right VC, let me pitch this idea to you and have just a nice confidential talk and see what you think about it. VCs always love this thing to be in front of the companies, of the project, so that if they really like it, they can some sort of preempt it, because this is a competition also between VCs, and it's a giving advice business, and it's always good for the networking, and you get some sort of a feedback of what are your weak points or strong points and where you should improve so that you can really meet the standard. So it doesn't need to be a 2 hours meeting. It can just be a 30 minutes call saying, okay, I'm doing this and that and that. Where should I improve my pitch or my company so that I can present it to you officially in 3 months, 6 months, 9 months? And then if the VC really likes it, it's going to tell you to come back and work with him to refine it. Because if he really wants to invest at one point, he will help you find the right position, the right business model, the right teams, the right people, and the right way to pitch it, so that at the end he can invest in the company. So that's always a good thing to start a bit earlier, not to ask for money, but to ask for advice. And it's always, of course, a bit of ego. It's always nice to be asked to give an advice. There's always this ego thing in the world, so you should not forget it. It's you ask people for their advice. If it's nicely done and not too cumbersome, people are going to give it to you, and it's really valuable. Actually, I think advice are as a best free thing you can give to people, even good or bad, but you have to take them in and try to understand why they give you this advice. And if even some bad advice can be very profitable, because you can understand why it's bad and find the reason why and find an explanation to say, okay, this advice was not good, or this idea was not good, but at least it helped me try and think and refine my way of pitching and presenting my company.
So basically, distilling it down into a process, it would mean that when someone starts a company, it absolutely makes sense to reach out early to VCs, not with the question for money, but with the question for directional advice. So to approach them in a way to say, look, I'm about starting that company. You hear a lot from the industry because you are positioned in that industry, which means the entrepreneur should do a little bit of due diligence work himself or herself, finding out which VCs are working in that area, and then just be bold with the approach and not shy back for virtual being blacklisted because he approaches a VC without the wish to get money. So
exactly, and I think it is something that you should not be shy about. You should be really open to discuss with a lot of different people, VCs, of course, and also actually this is something that is really hindering the development of startups. This kind of secrecy. Like I don't want to talk about my tech because I might get copied. I might have some. Does not happen that way. You go, you discuss with people, and maybe you'll give some information to your competitors, but the time the process is understand it, and if you have some IP or some patents, it's really hard to get around, especially for a small company which does not really exist on the market and you're not really threatened by that. So you should really be able to say, okay, let's talk about it and see what we can do, because it's going to give you much more than you gave away. So I encourage entrepreneurs to speak about it openly and not be so secretive and say, okay, I have the next Google, but I don't want to talk about it because people are going to just steal my ideas. It doesn't happen that way. Mostly it's not the idea, the value is putting the work in. So
yeah, it's I once saw the picture that success is 5% idea and 95% hard work. So exactly. Having an idea is a great thing, but if someone doesn't put in the hard work, and that sometimes might be a mode by itself, so a team that is executing on an idea might not be better like others, but they are just sitting down every day for 12 hours and getting the work done. Coming back to this, when is the right time to approach a VC? So basically, every time is the right time to approach a VC with the right question. So asking the question of advice is always very welcomed. But when a company officially starts fundraising, coming back after 3 years with no progress would be a little bit neck-breaking, I think. Is that
yes,
right?
It is. Yeah, that's a problem of reaching out to a VC with a business plan and saying, okay, I'm going to raise, let's say, 3 million euros, and it does not happen. And you come back 2 years, 3 years later, and you say, okay, I didn't raise the money. I didn't do what I was willing to do. And actually VCs, they keep track of it. They have the former business plan and they bring it back and say, okay, why should I believe you now since you haven't done what you were saying? So it's always a difficult exercise to say, okay, I haven't done what I was telling you 2 or 3 years ago, but I've done different things, even better, maybe not, but at least you have to be able to explain why it didn't pan out and why the success that you're pitching now is different, or you have to be more confident into this new plan than the former one. And yeah, you can really be disappointed and say, okay, I don't trust this person anymore because he told me that it didn't happen and now it's this. But we all know that you're not going to make 100% of your business plan. If you do 50% already, that's already great. If you do 5% of your business plan, that's a huge problem. And maybe you have to explain why you didn't do it and explain the pivoting, why it's better now, and have some really strong proof that it was a good choice. So when you don't succeed in fundraising, it's not the end of the world. But when you don't really achieve your business plan, that starts to be a problem. And then you really have to think about what can I do to try and improve the situation. And mostly when you don't find money within VCs, you have to go through business angels, subsidies, customers, and maybe try to pivot and do something which is less capital intensive, because if you don't find the capital, you have to find another way to work. So maybe go into services more, go into consulting, go into partnerships with other customers or partners. Find other ways. Just be flexible and do not say, okay, if I don't get the money from VCs, I just close it down and go do something else, because that's not the right approach. You should be able to try and say, okay, I want to have different opportunities, different options in front of me, and this is the name of the game. If you just have one option, it's going to be really hard for you to negotiate anything. So just try to have different options. Of course, the best ideal case would be to have a lot of VCs in front of you and be able to negotiate the best term sheet and the best terms. But in real world, sometimes you have to choose between one VC, some subsidies, a partnership, or a few customers, and say, okay, what can I do? How can I define this thing and find the right combination of options? They're not exclusive. They're not mutually exclusive, so you can try and combine them in the best way to be able to defend a bit your position, your valuation, your company, because this is a huge point at the end.
So I think the key messages for me there are being open and honest, not shying away from talking to VCs, but being clear on what you want. So it's never a problem to talk about ideas and asking for advice. And not only approaching VCs when there is an immediate need for money. So this
Yeah, it's because you kind of feel like you're just a money pipe and you're just draining money to the entrepreneur. He's going to come, say, hello, I need a few millions. And then he goes and he comes back 2 years later and says, okay, now I need some more millions.
Sign here, transfer there, and we see us in 5
Exactly.
years again.
And see you again. And yeah, that's part of the idea to try and select the right VC for your company. They have a huge network, these VCs, of course. They're experts in their field, and so they know a lot of tech, they know a lot of solutions. So they can give you very great advice like, oh, you should go talk to this type of people for your subsidies. You should talk to this guy in this industry. And that's also some sort of marketing and commercialization of your product already, even if it's just a tech or an idea. You're already commercializing your idea. So you have to find people who like it, who want to help you do it. So yeah, it's a good thing. And yeah, the worst thing is you're going to say a no, to receive a no, saying I don't have enough time, so no thanks, come back when you're ready. And the best thing is, okay, let's discuss it and I might help you do it. And if I really like it, you'll be in my little papers and I'll be waiting for you to be ready to invest money.
So I know it should be respected and not countered with hundreds of emails. And but this means for entrepreneurs that it's really hard work to do proper market research on the VC world, to talk with VCs far before they need money, to get their advice, information in, travel to conferences, engage in conversations, which really means it's work. So this is work that must be integrated in a startup far before there is an actual need of money. And the companies who don't do that, who start this process when they are in the process of fundraising, most likely will miss because they miss this process beforehand. Is that a correct picture?
Yes, of course, if you have a great tech and you're in the perfect trend and you just come and say, okay, I need this money in 6 months and everybody has a lot of money and they want to invest, you're going to succeed. I won't say it's not feasible. It's just much easier if you started with a few VCs that you know and that are following your company and just come back and say, okay, now my round is starting. How do you want to invest? Will you want to invest? And the hardest thing is to find the first investment leader or co-leader. And when you have this investor, you can build on it and you can try and do this kind of aggregation of different parties. But yeah, the first part is to find the right one. So you can spend quite some time trying to find him. And when you have it, it's like something has just been broken and everything goes right in the right direction. It's okay. Now that I have my first commitment, the other one is coming, the third one, the fourth one, and everything goes in the right way. So it's a bit of management of who is going to be the first, and it's always difficult for VCs to be the first. It's much easier to be the second or the third, and say, okay, I'm investing with this type of people. So yeah, so you also have to find sometimes a good syndicate of people that are going to work together and be convinced together. Because yeah, we know we're going to invest once, but we know we're going to invest twice, 3 times, 4 times maybe. And so we need to have the capability to defend the positions. And so it's better when you have a few VCs around the table than just one. If it's a very big one, of course, one is enough. But even this thing now, you see that you were mentioning that in Europe, you have bigger and bigger investment, larger rounds, like tens of millions of euros for seed rounds. That's something that we didn't see 10 years ago, even that's 5 years ago. And now it's coming. And you see VCs are getting bigger, but they are making bigger rounds. So they still want to be 3, 4, 5 around the table. And they don't invest 2 or 3 million anymore. They invest 5, 10, 15 million. But they do that together so that they can really be stronger together. They know this idea of being many VCs around the table. Even if it's a hard work for the entrepreneur to manage all these people, all these VCs, it's much more comfortable for VCs to be with other investors like them.
But this work must, so everybody who wants to get VCs on board to scale the company faster must appreciate this work. There's no way around it. So it's not an entirely transactional system where the contact is just for transferring the money. It's really about building relationships. And
yeah, exactly. And I would say that when you're an entrepreneur, your tech is your product, your investors are your customers, and you just should do the same. Like, okay, talk to your customers, try to see what they want, what they're waiting for, where they are, etc., and try to find the few that are going to be the nice niche of the mind, nice fit for you, because you don't have anything else. You you just have an idea, a technology, some patents, a bit of a prototype maybe. So you're going to see your customers all day long, and the customers are the VC, and then you're going to talk to the industry and see to try to prove that it's a workable product. So yeah, so you do your work and take the time to do that. Actually, I think the tech is not the most essential thing in a startup. In the end, it's the time you spend trying to promote the idea and sell your product and your technology.
Let's stay a little bit with these either-or questions. I have another one based on what you were just saying. When I'm talking with European founders, I very often, maybe it's just my perception, and that's why I asked the question if it's just mine or if you also agree to that. I very often got the impression from European founders that they are very tech savvy. So in the decks and in the material, I see a lot of processes and details of the product and how great the product is and what the product can achieve and how they can develop it and make it better. And it's all about the product. When I talk with American entrepreneurs, one example from my past is that one entrepreneur once told me, look, my friend, all you need is a vision. Then you find 3 friends and talk them into founding a company with you. Then you talk to a few VCs and get your first 20 million into the company, and then you figure it out. So
that's the US way. Yes, it's not the same in Europe, unfortunately.
How do you see it? Which is the stronger story?
I think it's right. In the US, you can really raise a lot of money on a vision because they know you're going to find the people to get the work done and find the right approach, etc. They're much more in terms of, okay, I want to have a vision, and then we're going to figure out the tech, hiring the right people, doing the right approach for the market, etc., etc. It's not the same in Europe, and maybe it's because of the entrepreneurs, maybe it's because of the VC. I would say it's both. I would say VCs want to be sure that it's the right tech and the best tech, and it's going to be better than the rest. And so they want to go into that. Founders, they master this thing, and they really want to and love to talk about it. So they want to talk about it, and they're much less comfortable talking about the vision because it's more of a marketing approach, a company approach, and a scientific approach. So I would say it's an evolving thing. I think like 20 years ago in the US, it was much closer to what we were doing now. So I think we still have this 20 years gap with the US. It's narrowing a bit because communications are faster. People are moving a lot between these two areas. So it's easier, but we still don't have the same amount of money. We still don't have the same successes. So we still have to do a lot of things in Europe so that we can catch up. But I see more and more people trying to say, okay, I have a tech, let's try to find the vision and combine both, because I know I will have to rely on my tech to convince European VCs. But we're still going now into this vision thing where, okay, I know that I need to be able to sell something which is completely unreal for the moment and will become real in the future. And some people are going to buy or not buy on these ideas. So it's changing a bit, but yeah, I would say it's cultural between the US and Europe, and I would say also it's an evolving process. So I'm not sure if someone were to try and raise money in Europe with a vision, just a vision, if he's not a serial entrepreneur with a huge success, I'm not sure he would be so able to raise a lot of money in all over Europe, maybe a bit more in Israel, for sure in the US. But that's why we come back to tech, and we're much more basic in the basics of the company. One day it will change, maybe. When we have enough serial entrepreneurs, we just can pitch and say, okay, I've done this and that. Now I have this vision. Give me the money and let's move on. And people will follow that because of the success of the person in front of them.
I think this is, in my opinion, the key words that you were saying. It depends on the entrepreneur. I think when Jeff Bezos approaches a VC and say, well, I have an idea, I put 20 billion on that, would he want to join me? Maybe it's a different story and he just needs a vision. compared to the first-time entrepreneur, 20 years old with the first company, no track record, maybe it needs a little bit of a different approach. So as you say, when we have more entrepreneurs with a track record, maybe the culture changes a little bit.
Yes, exactly. And the power changes. When you're a VC in front of a successful entrepreneur, you don't behave the same thing than just the first time. Just new tech, PhD, postdoc, etc. And it's normal, it's life, someone who has already done a successful exit or a few, of course, you're going to give him much more credit about the next idea than before. It's based on experience and money. But in the end, this is, I think, why also you can just come now in the US and say, okay, I have a vision, I have an idea, I have the right team to do it, just give me the money and we'll execute. And people believe in that because it's already been done. But that's the way it works, and we hope we'll have enough huge successes in Europe so that we can see these serial entrepreneurs come back and just not stop after one company and say, okay, no, I'm going to enjoy life and just be a nice business angel, and that's it. Sometimes I think in Europe you have this idea about okay, I've done a bit of money with my first company, I'm just going to live on that, be a business angel, have a good life and not go for the next one or the next one. And when you look at the big names, of course, you have the ones who had a big success with their first company, but you have also the Elon Musk of the world. It was the second, third, fourth company, which was a huge success. Even if the first one were very successful at first, the next one were game changers. So you can say, okay, what would have happened if Elon Musk, after the first company, had said, okay, I had a few millions, I'm good, let's retire and do something else. No, he went back because he was dreaming something more than just money. He was dreaming about doing things.
I think entrepreneurship is not like playing the lottery. When I look at the most successful entrepreneurs in the world, like Elon Musk or Jeff Bezos, they just play the game forever. It's, I think, a lifestyle and a mindset that they just tapped into. They like it, they love it. When I also look at investors like Peter Thiel, for example, it's just one investment and one company and one founding process after the other. I think it's more a lifestyle. And I don't know if people who approach it like playing the lottery, who say, okay, I create one company and then I have a big hit and then I have a good life afterwards. I don't know if that really creates success. What's your opinion?
I would agree with you, but I'm not in the position to say, okay, what would you do if you were to get, let's say, 2, 5, 10 million euros? Would you say, okay, I'm coming back and working hard, or I'm just enjoying my life and buying one of a few apartments this and there and going on vacation trips? I really think it depends on the characters of people, and I think that the American character on this side is much more. I live with my work. My work is myself, and so I enjoy this thing. And in France, we still have this old thinking about work as some sort of punishment, or some sort of bad thing, and it's deep in our culture actually, because that's the idea of work is. It comes from a word which was some sort of a torture in Latin, so it's not really a positive word. And during the Middle Age, it was a negative word to work. When you were noble, when you were the higher strength people, you didn't work and you didn't want to work because it was really badly perceived. So I think there's a bit of cultural background in this area, and also I think a bit of what's my ambition. And I think these huge successful entrepreneurs in the US, they have an ambition which is not about money. It's about changing the world. Even it's a bit of a too much used word, like I want to change the world, make the world a better place, etc., etc. Deep inside, it's a belief that a lot of people have. They want to change the world, make it a better place, and make money at the same time. You don't have to be to have opposite sides of this thing.
Yeah, money.
When you make it.
Sorry.
It's just a driver. It's just a driver of success. So I don't really care about it. That's why they're giving it back hugely, because they know it's too much. When you look at Bill Gates, and he's done a huge amount of money, and then it's giving it back. So what does it mean, giving it back? It's just realizing that it's too much, and so I have to give it back to the community, to the world, because I want to change things, and it's not just keeping it because it's way too much. And I think they would by them, they would agree on that and say, okay, and that's why you have this Warren Buffett initiative, like giving 50% of my fortune to the rest of the world. Even 50%, it's a low number when you have billions and billions. But in a way, this is the idea. Yeah. I don't really care about the money. I care about the success, and from the success comes money. And that's just a driver. And I think they would get 10 times less. I don't think they would change their behavior and the way they work. They would just be a bit more concerned about, am I treated fairly regarding the value creation? Because, of course, you start with an idea, you start with a concept, you work a lot, and then you want to be rewarded proportionally to what you brought to the company and the work. So that's always this question of ego coming back. How much am I worth?
No, that's true what you're saying. Probably it's really a cultural difference. When I look at the self-help books and books I've read from entrepreneurs from the United States, mostly they talk a lot about finding your area that you're passionate about and learn some skills that you need in this area and create a company and serve society. And on the other hand, they view money as a tool, not as an end goal. They just say, okay, if you have a vision, you need some money, then it's the tool that makes the vision happening. But it's not a goal to have a lot of money. And looking at the lifestyles of the great entrepreneurs, I mean, of course, they have a high net worth, but in relation to their net worth, they live pretty frugal. So it really looks like yes. Money is just, they use it to make their vision happen, but it's not the goal to become rich. And when I talk with Europeans, probably it's a little bit different. Like you said, it's the goal to have a good life and spend 50 years without needing to work as a punishment.
Yeah. I think it goes back, I haven't mentioned that, but I have a PhD on philosophy and capitalism, and I've done quite a lot of work about the origin of capitalism. It goes back to these ideas from Weber at the first decades of the 20th century that capitalism is from a Protestant idea, and the entrepreneur does it in terms of a religious action. It's just to make something good out of it, and the profit at the end, the money at the end, is just a side effect of it, just some way to measure the success of it and the success of the benefit. And they have to reinvest it in the company, so they don't use it for their own consumption. It's not for luxury. It's a process and something that they reinvest to keep the company growing and to make it good. And at the end, and you could read Weber, it's a very great book about the origin of capitalism with the Protestant ethic. It's there is this idea about Benjamin Franklin, who was at the end of his life a very successful man for his time, very, very rich, even if he had slaves, and it's controversial now. That's another story. He was just really happy about what he did for his country, for his city, for the people he employed. He wasn't happy about the money he made and the amount of money he made. It was the positive actions he made with the human society. So that there was this idea of common good at the end, which still is around every action that we do. It's not about getting rich by yourself. It's also contributing to the common good of the world. And capitalism was a way to say, okay, you can do both. You can target money and also do some good things thanks to the exchange. So that's just closing the parenthesis about the origin of capitalism, but this is truly something that exists in the US, I think, a bit less in Europe because it's between Protestant and Latin. So Latin world would most see money as a bad thing. So that's something that has to be taken into account also in the way we manage it and develop our companies.
Yeah, there's also in the Bible, I think, a quote that is very often misquoted. It's money is evil, but I think the quote is the love of money is evil. So it's not basically money, but putting emotions towards money, which comes back to what you say with the United States attitude, treat it like a tool. It's nothing. It's just you use it like any other tool, like a screwdriver.
Exactly.
Let's come a little bit back to the M&A world. I got my training in public companies, and mostly whenever I was involved in drawing up business plans and calculating investment cases, the preferred holding period was forever. So we had these endless discounted cash flow calculations for the next 100 years. So it was really building something lasting. Then I switched into the life science world and had the pleasure to start working with Innovative spinout, which was very well financed. Nomura, for example, was on board. So it was a 40 million financing round back in 2006. And there, the first time I learned the term that VCs need an exit. And I sat there and said, why do they need that? Let's build a company. So it's forever. Can you explain a little bit what an exit is and why it is key to success for VCs?
Yeah, actually, this is really important to understand that when you're an entrepreneur, because you have to be able to think like a VC and realize what they're looking for. They want to be able to give back the money to the people that invested in their own fund. So they have a small definite period of time, which could be 8 years, 10 years, 12 years. Sometimes a bit longer if you succeed. And you have very specific corporate VCs or VCs related to banks, when it's like a forever fund, it's a evergreen fund. So this is quite different. It's really specific. So I'm just going to focus on the one with normal standard 10-year fund. You have to provide them with an idea of an exit when you talk to them, because you can have the greatest idea. If the exit time is in 50 years from now, we're going to tell you, okay, in 50 years I'm retired, the world has changed 10 times, maybe it's going to make a lot of money, but that's not for me. I want to be able to find a way to exit my investment in 5 to 7 to 8 years, and that's a good side of it. Sometimes it's 3 to 5 years. For growth stage companies, you want to come in and get exit 3 years later. And for leverage buyouts, it's even shorter sometimes. They do that every 18 months or every 2 years. So you have to be able to provide the exit strategy, not say, okay, I have this type of partner already willing to acquire me in 2 years at this price. It would be too easy. But just saying, okay, I have this type of target for my acquisition. If I'm going to do acquisition, I want to do an IPO at this stage, and this is the valuation that could be coming out of this IPO. Or if it's just financial play, I have a solution for you to exit in 3 to 5 years with this multiple, because I'm going to bring my revenue to this type of value, my EBITDA, or blah, 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 with multiples. You can do some sort of a secondary transaction. But you have to provide that to the VC so that the VCs understand that their constraints, what they're looking for, and they can make their own calculation and say, okay, if I'm going to sell this company 50 million euros in 5 years, how much is it worth now? What are the risks? What is the drive? And then they can provide some sort of a value. You could have the best company if you don't see a great profitable exit at the end. As a VC, you will say, okay, just do it as an association or something else, because if I don't make money out of it, why would I invest? And that brings another question, which is even more important. Do you really need VCs if your goal is not to exit them from the company? If you don't want to have them for a short period of time, but you want really long-term investors or other type of financing, maybe you should go in another direction. VCs are really for this fast-growing companies where they need a lot of cash. I've seen companies, when you were digging into the business plan, actually you discover that they didn't really need the money, but they wanted to have the money because it was nice to raise money and talk with VCs and stuff. But in the end, I was like, okay, you need a few €100,000. Why are you bothering yourself doing this? But yeah, because we want the competitors, the world, etc. They want us to raise a few €1 million, but they didn't need it. And so the answer was, if you don't need the money from VCs, don't spend your time and your energy to go talking to them. Try to do it differently. It's not a shame to not raise money from VCs. And it's even a better success if you can make a great company with your own money and your own customers, your development. Congratulations to you, because you didn't need the money. At one point, you might go and say, okay, I want to accelerate, I want to get more, and my organic growth rate is not huge enough. Okay, fine, but it doesn't. You don't need to go directly to the VC every time, and you can find other ways if you want to go there in different areas. And if you really think it's going to be your company forever, just be clear and say, okay, I might have to exit you by myself, and this is going to be the price, and that's what it's going to take. But usually VC wants M&A or IPO. This is the most profitable things for them to exit. When an entrepreneur comes and says, I'm going to buy you out in 3 years from now, It's going to be difficult because it's going to be a hard discussion at the end, even harder than at the beginning, because after that, it's real money from the entrepreneur to buy you out, or debt from banks, and it's not really the same game. So that's not the preferred exit. It's mostly finding someone who wants to really buy the whole company or do an IPO with the company. So that's what you should at least have somewhere in your pitch deck. How do we exit from this thing? What are the targets? What is the way? Is it 3 years, 5 years, 7 years? And mostly we want to understand what the entrepreneur wants, not what the VC wants. We know what we want, but we want to know what the person in front of us want to do. And don't lie about it. If you want to do 10, 20 years in your company, just say it and try to find the way to do it. But don't go and say, okay, I'm going to exit you in 5 years, but actually I don't want to exit the company. I don't want to do it, because it's going to create a lot of frustration and a lot of problems in the end. Because you kind of commit to that, and you'll have in your shareholders agreement different articles saying, we can drag you along if we want to sell the company and blah, blah, blah. And after X years, we can start an M&A process, etc. So you have to be really clear about it, that it's something that you want to do. And of course, there's always at the end the price issue. If it's too low, or if it's not the right valuation, you can say, okay, I want to keep going. But this is a discussion with the acquirer. You can say, okay, we're selling only 40% of the company, or 60, or whatever, and I keep going for the next years because I think I can make even more money later. I've seen people doing a lot of money, not on the first part of the project, but on the leverage buyout after that, because they stayed at the management and they reinvested in the company. And when it went very, very successful after the VC part, it was for them a huge success, because they believed in the future of the company and they could stay longer. But VC will have to exit, so you have to find them a way to do it. And so keep a part on your pitch deck. So exit strategy, what do you want to do? How do you want to do it? To whom? And what kind of valuation you're looking for?
So that means your recommendation is to really have a clear idea about an exit scenario for VCs and not just leave it open. And then also it should be an idea for an exit scenario that is compelling for VCs. If it's not compelling for VCs, there is no need to approach them. So, for example, while you were speaking, I had some ideas in my mind. Let's try it a little bit. So, an exit scenario, how would it sound to you as a VC when you say, well, I sleep better with 10 more millions on my bank account. Can you please transfer it? And you get the interest rate back. So would that be a compelling exit scenario? I don't think so.
Of course not. Of course not. Yeah, you have to be. After that, it's always a question about the perception of the risk. If it's really early stage, you want to do times 5, times 10, times 20 maybe on the investment, which is a lot. When it's let's say Series A, B, or C, you can say, okay, if I do it times 2, 3, 4, it's all right. The risk is not that big, and we already have some values in the company because of customers, development, etc. So yeah, you can adapt the valuation expectation depending on your stage. But in the end, you have to show a number which is big enough so that the VC say, all right, I want to invest in this one and not any other one that I've seen in the last few months, or few years. So yeah, so you have to be able to credibly say this company is going to be worth 50, 100, 500, 1 billion, and be able to defend this idea and say, okay, if everything goes well, I can sell it 1 billion. If it goes average, it's a few hundreds. If it doesn't go well, it might be zero, because we know it might be zero, but we could also sell it for the tech at a few tens of millions, and then people will say, okay, on this kind of strategy and approach, we can give you 10, 20 million euros and try to develop your company. But this is really a question of how much risk do you perceive and how much money do you want in comparison to this risk. And a very funny thing is, at the end of the VC world, when you're raising hundreds of millions or billions of euros, it's not even a multiple of the money. They want to do 10% per year, or 0.5, or some 1.5, because it's such a big amount of money and you're such a successful company that they're going. It's closer for them than an investment in some equity on the public markets or a real estate or stuff like that. So it's not even a startup anymore. It's just, let's say you were to invest in Uber right now, you would not say, okay, I want to invest and say I'm going to be sure to do a 10x because I know the valuation of the company is really high, and so I'm going to have a very lower expectation, which is much better. So the most successful you are, the lower the expectations are, and so in the end, the easier it is for you to raise money because you have a larger pool of people ready to invest because of this perceived investment security.
Yeah, there is always this S&P 500 ETF hurdle rate, in my opinion, which lies between 10 and 15%. So it's rather safe to invest money in an S&P 500 ETF over 10 years compared to a startup. And another value proposition, for example, a proposition for an exit would be to say, well, I have this access to free key technologies in the market. It's rather new. I need 100 million to move it up. And when I look on the stock market, on the Nasdaq, companies who developed technologies like that have a valuation between $1 to $5 billion. So this is the aim. Would that be a compelling proposition? It's just made up picture, but would that be something that's compelling?
Yeah, it is. It is. Actually, you really have to look at your competitors and say, okay, what is the valuation, multiple of revenues or EBITDA? But usually you don't use EBITDA in startup because the more they spend, the happier we are sometimes. So they grow fast. So this is a very unorthodox way, but it's been very successful for lots of companies to say, I don't want to be profitable over the next 10 years. I just want to grow my market share and become the market leader. So that works a lot, and VCs love it when it's credible.
So you should really strive for becoming the number one in the market and not being just another company.
If you're early enough, if your technology is good enough, you could do that. Or you can say, okay, I have a niche market, I'm a nice add-on, a nice technology, and I want to be acquired by a larger group because I'm going to provide them a lot of value. That's really depending, coming back to the point we were discussing, that really depends on what is your goal, what is your vision, and what can you achieve. I'm sure if you were to create the new LinkedIn now, you could create it, but since you would be the second mover and there's a huge network effect, will it really work, or how should you approach it? I'm not sure you would be that big compared to LinkedIn. You might find a nice niche about a specific job opportunity or type of people, but I'm not sure you could ever become the leader again. So that's something that you have to really understand and discuss and put into your vision, because it's not going to be credible to say I'm going to replace LinkedIn, or you have a very great technology and concept, and so everyone will be willing to hear about it. Otherwise,
so it would also be understand your personality and the personality of your team first before reaching out to VCs for making a deal. Yeah. If you are not the type of who wants growth, who wants to have a grand vision, and who wants to lead an industry, probably the case you have in mind is not the right case for a VC. So it's just having a comfortable life is probably not a VC case.
Exactly. And and I think you really, if you're an entrepreneur and you have a dream, you really think to try and confront it to what's around you, and especially VCs, because they might give you a very good feedback in terms of, okay, I've seen 5 other companies with a similar kind of dream. Look at them and look at what they did and what happened to them. Because sometimes it's much easier to go and talk to people and have their feedback about what you dream about and what you want to do, because they have the experience. And even if you can do a lot of Googling and stuff and try to look at other companies on the internet, it's much more efficient to talk to people and have their real life feedback and see what's really going on, and not just what is transpiring on internet. Internet is a great thing, but it's not the reality. It's an image of the reality. So really should try to take with a grain of salt what you read on internet, because this is not the real truth of what's going on. And it's always been worse or better depending on how you want to pitch your things on internet. It's never that black or white in the real world.
No, it's what you say matches my experience that I got back in the 90s. So it's basically putting first the company together and have a look at what direction the company can take and how the market evolves, and approach investors only with a growth case. So basically, with a clear growth case, it makes sense to reach out to VCs. When I look these days at startup companies, I very often get the impression it's all about fundraising. So it's all about raising this round and the next round, and then you have incubation program, 200,000, and you have the next investment show on television. So sometimes I have the impression that founders lose a little bit of the contact to the customer and the reason what a company is all about. And the company is all about putting a product together, putting it on the market, finding a customer. And when you want to unlock tremendous growth and you have the compelling story, then approach a VC.
Yeah, I agree with you. You should actually. After that, I agree with you, but I have to admit that most of my investment were in the pharma world, when you never really see a customer because it's so far away that you're going to have sold the company or did an IPO way before that. Because sometimes you reach a patient. It's a biotech is a very long process, but yeah, in a lot of other industries, I agree with you completely. You should have some customers' feedback, and even the greatest thing would be to have a customer willing to help you develop your product. Mm-hmm. That's the best way for everyone to show that your product is needed. Is a customer telling you, okay, I'm going to help you through financing. And that's why I love these Kickstarter things and these crowdfunding things, because you have the real feedback from real life people saying, okay, I want this product and I'm ready to pay in advance for it, or for the idea of it, even if it could never work. So that's a really great way to have a feedback. It's not recommended for every type of product, of course, because if it's B2B, if it's a really long-term development, you won't go on Kickstarter and say, give me 100 million and I'll create a cure against cancer, because I'm not sure that would be something you could really...
Some people do that. So there are some crowdfunding platforms who picked it up. I don't think it's the right approach. I mean, for me, a customer must not be a consumer. So it can also, like I said, B2B, it can also be a pharma company. But in the end, I think also a life science company or a drug development company needs to have some perspective of the need of the pharma industry.
Yeah, for sure, because they are the one who are going to buy the company in the end, or they are the one who are going to be competing against. So you really have to have their feedback, and it's really interesting. Even I take the no's from VCs that has really interesting and important answers, because they give you some sense of direction and some sense of where you should improve and where you should stop improving and say, okay, I'm good enough. I see in a small company, I see as a success when investors stop asking questions about the technology. It's because you've passed this idea of, is the technology going to work? It's like, okay, now you have a few customers, you have a product, you're starting to sell it. What's your market approach? What's your business model? What's your commercialization scheme? What's your pricing? Competition on the market, etc. And they don't even talk about the tech anymore. It's just something of the past. It's done. It's accepted. And this is a success when people say, okay, I don't really ask questions about the technology because we see the product and it works and it has customers. That's all right. It's a way to say that the company has been evolving, and now it's not about tech anymore. It's about how do you make it available on the market. And so, yeah, I would say, and I'm repeating myself, that the more you talk to the people around you, the better it is. And you should not be shy about it, and you should really see and go and say, okay, maybe this is my direct competitor, but it's a very interesting way to discuss with these people and see how they react. And of course, they might react saying, yeah, your product is not good enough, or this is it and this. But at least you have the qualifications and the weaknesses of your product. So that's also a good feedback to obtain.
Now, I think VCs, business development in pharma and life science entrepreneurs should spend more time talking to each other without having this transactional or being transactional in mind all the time. Business to consumer, in my eyes, is a little bit simpler because there is a lot of information on the internet already of consumer products, what are consumers looking for, and there is a lot of market research available for free on the internet. When you look on the pharma industry, I think the real needs are not very well documented because people just don't have time to put that together, and the needs are more complex. So I think this can only be resolved with communication, sitting down with people and exchanging information. What have you heard? What have I heard? And then structure the company accordingly.
Yeah, I agree. But sometimes people think about information as a value. So the information have a lot of value, and so they keep it for themselves because they say, okay, I don't want to share it because I know what kind of strategy or technology or things people are looking for. And so this is a very valuable item, and I want to keep it to myself so that I can market it or use it on my own. So it's a very different way of thinking about it. Maybe because the valuation impact is huge, the monetary impact is huge. When you know that a huge pharma looks for that, it has a huge of value for the people who wants to sell this type of things to the pharma. When you know that the average customer wants to buy something for 100 euros, it's not that much of a value. Even if you have millions of people like him, that's not that valuable, and you cannot sell it the same way. So yeah, but I would agree with you. We need to have more communication between farmers and VCs. Most VCs try to go and try to get some money from the farmers so that they can invest in their own fund and have their feedback and their vision of the products and the technologies they're developing. But yes, every type of companies have their limits, so they cannot invest in everywhere. But sometimes it's really interesting to listen to presentations of big farmers and see where they're going and what are the trends, and then discuss with the business development guys or the scientists and to see what's really going on in there. So yeah, that's a really interesting way of getting information. But unfortunately, when VCs have to decide between spending time on transactions, making deals, exiting companies, following companies, and for time for communication to try to get new information and have some type of new feedback, they decide on the first part because this is what they're paid for, this is what they do. And so it's a bit like entrepreneurs. You say entrepreneurs are just not looking far away because they always have their everyday problems to solve in the company. It's a bit like the same for the VCs. They have their everyday business to do, raise funds for their own funds, invest the money, exit the companies, etc. And so they don't really look a lot ahead, except that a lot of the startups coming in gives them a lot of information and insight. Actually, it's a very rich job as a VC because you get so much information from the different startups. It's like you have a very privileged way of getting informed about what's going on in terms of technology, science, society, because all the startups come and give you this information. So it's a bit of a very interesting, for curious people like me, it's very interesting to be a VC because you have a lot of information that you would have never thought or looked after. And it just arrives with a nice format about how can we make a company out of this trend, technology, market, etc. So that's really interesting in this way.
Yeah, this was also the perception I got from the VC world. So whenever I worked with VCs, I really had the pleasure to work with extremely smart, educated, and well-mannered people. And I always admired VCs for putting all that money to work and help entrepreneurs to create technology and companies who improve the world. So I just wondered, because you said that you left the VC world and joined the also glorious world of entrepreneurship, but always I think entrepreneurs get a little bit more dirt on their hands. So what was the reason why you left the shiny glowing stage of VCs and got more down to business and into the operations?
Actually, it might be surprising, but for me, it was a necessary move just because I wanted to be more involved in my companies. And don't get me wrong, I loved my VC job. It's very fun. It's a lot of information. It's very exciting. But I wanted to have more impact on my companies. When you go into larger funds and do larger rounds, you become less of a factor in the success of a company. Yeah, you might have bought the 5, 10, 15 million euros that the company needed at one point, but it's not what's completely changed the thing. And of course, it can be frustrating for the VC because I want the things to be done one way, and I'm not going to be the one to decide in the end. And I might be wrong, I might be right, but I wanted to be able to prove and see if my decisions were better than others. And it can be really frustrating when you tell an entrepreneur that he's going in the wrong direction and it still goes there, And at the end, you were right, and you could not do a thing about it because you didn't have the power to do it. Because when you have many VCs around the table, just not listening to one. So I wanted to go on the other side. But since I didn't want to be completely an entrepreneur because I'm too curious and I have too many subjects of interest, I decided to go into a startup studio, which is a new trend in the VC world, coming from America, of course, coming from the US. You have example like Flagship, which is doing a tremendous job with this kind of things, where you're just not financing companies, you're also creating them and nurturing them. So you're really as a part of the creation process, which is a part that I really love in terms of the intellectual excitement that it brings and all the possibilities that you can make. So I decided to go into a startup studio in between Vienna and Paris, so that I could have my both legs in Europe and create European companies at first, because I really think we need to have European startup from the start, and be able to contribute as a co-founder to the company, take the best deep technologies that I can find and work with the founders, with the scientists, or maybe people from the industry, and create the best startups. So that I'm a bit in between still VC and an entrepreneur. I didn't really decide to just focus on one company, but make something like 1 or 2 per year. And if everything goes well with the team in a few next years, and a bit of money to invest in each of my startups, and really become a studio, like you would have a movie studio, creating 1 or 2 movies a year. That would be the same for a startup. And I think we can really professionalize this starting point, instead of having an entrepreneur with a learning curve, learning the network, learning how to do it, different positions, different options, etc. When you have expertise at every part, let's say a CFO, a legal person, an IP attorney, commercials, commercial and marketing people, fundraising capabilities, etc. It's much easier for companies to really start from a great starting point and really grow fast. That's the idea. We want to have companies which grow faster than they used to do in Europe, and not start with one country and another, which is one of the problems in Europe compared to the US. In the US, when you've done your internal market, you're the world leader almost, because it's a huge market. In Europe, if you're the French leader, the German leader, you're almost nowhere. So you have to do it again in every other countries, and in the US and in Asia. So the idea is to start European, and if you're already the European leader, you might be onto something. So that's why I want to do it this way. And I really believe in the cultural exchanges and the different ideas of people. So that's why I'm doing that. And that's why I'm still a bit of a VC, but mostly an entrepreneur now, because I get my hands dirty, as you said.
Yeah, it's a little bit, it's more operational work. The closer you come to the early stage world, and the closer you come to entrepreneurship, stepping directly into a role in an executive board, it's basically, especially in startup companies, it's a lot of groundwork that has to be done. So this is what I mean with getting the hands dirty.
Yeah, and I think I like it actually. Maybe it's because of my background. I studied right after my engineering school as a VC, as a baby VC, and then an analyst, and then a partner, and then etc. And I've never really done the job of being an entrepreneur in a startup. And I really think you have to have both experiences to be really able to relate to what's going on. And even if I've done it maybe the opposite way that it's used to be done, and you start as an entrepreneur and then you become a VC, I think it's still very valuable for my co-founders, so that I bring this idea about I'm a former VC. This is how you should talk to me. This is how we should do it, and let's discuss it, and let's see what I need, what I want, where we're going, and then what's the end point of it. So yeah, I'm trying to bring that up to my companies, and then it's completely open in terms of technologies. Of course, I have a focus in healthcare, but I also, as I mentioned, I'm doing cybersecurity, I'm doing clean tech, I'm doing nutrition, I'm doing a lot of ag tech. As long as you have a huge, nice technology, that's why I call it deep tech. I'm interested, and if it's and it has to have a meaning. Coming back to what we were saying about capitalism, it has to have a meaning. It has to have something grander than just make money, like climate change, stop climate change, change the way internet is done with hacking and surveillance, change the way you're polluting your bodies and trying to take chelates or molecules out of it, fight cancer, etc., etc. Things that are better, bigger than just okay, let's do a quick and dirty thing and get a few millions and go out of the way. As I'm more on the spiritual way of capitalism and industry. Like I want to do something good for the world, and it's much bigger than just getting a huge sum of money on my bank account, which is good. I don't blame it, but it should not be the end point. It should be the benefit, side benefit of it.
No, I agree with that. Having a vision how to make the world a better place is key to success for startup companies, and I think this is necessary. It's good to hear that you are now available for first-time entrepreneurs. So let me ask you one final question. Let's just assume you are at a real-life event in summer. It's possible in Austria, and you meet a lot of entrepreneurs there, and you don't have time to dig very deeply into conversation. And one of these entrepreneurs wants to have an advice. So one single advice in 1 minute. This entrepreneur wants to approach VCs and asks you this one question. What is the most important thing that I should think about when reaching out to VCs?
I think the most important thing they should think is, and it's a really basic thing, what do I want from them in terms of advice? What do I want to have their feedback on my technology, my access to market, fundraising? So just advice is, okay, I'm talking to VCs. What is the only points that you really want to see in my company? And sometimes I see companies, and it's really interesting to me. They just want to be right. They just want to give you what you want. They want to be right. They want to tell you, I have the best technology in the world. Yeah, I don't really care about it. You can have the best technology of the world about something nobody wants. So that's the point. Or I have the perfect vision of my competitors and I have the perfect way to make it happen. No, actually, this is the advice the only one advice I would give to this entrepreneur is just try to understand what they really want and give them this answer. If they really want to invest in a deep tech technology, early stage with unicorn potential, that's what they want. Okay. If they want to invest in a company with a market traction on the established markets, that's perfect. If they want to invest in a third mover, fourth mover in a new trendy market, why not? If they have a digital appetite, let's try to find. But just try to find the right answer for the right people, because I've been contacted by people. Funny things. I was investing in life sciences, and I was contacted to invest in solar panels in different technology on photovoltaic stuff, hardware, semiconductors. And I was like, why are they even sending it to me? They're not looking at what I'm doing. So just the single advice would be find the right person, the person you think is going to be attracted by what you're doing, and find out where he wants or she wants. And then just answer that. That's really basic commercial transaction stuff. You have a customer, you have a partner, you have someone in front of you. What does he or she want, and why do you want to sell him or her? And at the end, it should be fine if you find the right fit with this person. And another funny thing would be to say, don't listen to VCs, but it would be a kind of a paradox since I'm a VC. So you should listen to them, and you should listen to everyone, and then try to focus on and decide which advice is good and which advice is not good, but get them all. That's really interesting. Even if you disagree with people, it's always good to disagree. And I think a lot of people are not good at disagreeing. And you should be able to say, I disagree with you, and I love it for that. And I want to keep going on that thing because it's nice to disagree. It should not be a pattern. It should not be a disagreeing for the purpose of disagreement. But it should be good to say, okay, we disagree, and this is why we disagree, and make it really clear and simple. These are the reasons why we disagree, and let's not make it a big deal. Some people are too emotional about being in disagreement. It doesn't mean we don't like each other. It doesn't mean we don't want to work with each other. It just means that we have different views on a subject. And this is maybe why we don't talk about a lot of politics in the workplace, because people will have to disagree on that, and that might create some tension. So, but I think it's a good thing to establish a bit of disagreement sometimes and be able to see the opposite vision or different vision of the thing, because you have different arguments which are really interesting.
No,
you can always find it interesting.
This is absolutely sound advice, and I love it. Having diverse conversations, listening to both sides, also to a diverse range of opinions to come to a conclusion. I think this is key to success for entrepreneurs, not just being single-minded and going down one track. Sebastien, thank you very, very much for this great conversation and giving your insights into the VC world. Welcome to Vienna. Good to have you here.
Thank you. Thanks a lot, Christian, and thanks for welcoming me here. It was a lovely time, and I hope to keep working with you, the network, the ecosystem for the next year, so that we can really build the best companies here in Europe globally.
Thank you very much. Have a great day. Bye. Thanks for listening. Please share the podcast and make sure you've subscribed. Have a great day.